Welcome back to the channel, everybody, for another stock analysis. Today's stock is Fiverr, ticker symbol FVRR, which is in the HR and employment services sector with a current market cap of $875 million. Really quickly, I just want to let you guys know that later in the video, we are going to have a segment where we analyze potential future prices for Fiverr, so you do not want to miss that. Please hang around. It's something new that I'm adding for the very first time in this video, and I think it'll offer great information. For anybody who is not aware of what Fiverr is, it is a freelance service website where people can post either jobs that they like to have completed, or they can post their skills and services for those with jobs to find them and hire them to complete a task or service. Fiverr did just report earnings last night, and so far it is down on those earnings, even though it did post better than expected numbers. We can see that revenue was up 12.1% year over year, but the reason that it's down is more than likely because Fiverr's next quarter revenue guidance of $91.6 million was 1.9% below analyst estimates. That's not a huge deal, but as we'll get into, Fiverr is a growth company, and if growth companies stop growing, there's a lot of pain for investors. Taking a look at some of the highlights, we see that their revenue beat by 1.6% this quarter. Their earnings per share on a non-GAAP basis beat by 19.1%. Their revenue guidance was below expectations, as I mentioned, about 2% below expectations. And their free cash is up 26% from the previous quarter, with improvements in gross margin up about 2.5% to 83.7% versus 81.1% in the same time last year. Moving over to the company's shareholder letter, we can see that revenue grew by 12% year over year, and their take rate, or the money they make in each transaction, was up 130 basis points year over year. Those are the good numbers, but we do have a couple of less good and even bad numbers showing up. First, their active buyers are down 2% year over year, meaning less people are going to the platform to look for a service. And secondly, their spend per buyer is up 4% year over year to $271 per buyer. Now, that's not necessarily a bad thing, but if we think about the inflation rate being at 5 or 6%, and even higher in many other countries, as Fiverr is an international business, being up 4% year over year is actually a loss on a real adjusted basis. Now, it's not a very big loss, and I'm not sure that it should be worrying at this point, but it is a loss nonetheless. If we look at their financial outlook, we can see that the company is expecting 6 to 8% year over year revenue growth, which in general is good for most companies. But like I said, Fiverr was priced as a growth company, and 6 to 8% just is not enough for growth companies. So that is a big reason why we've seen the stock fall so much in the last couple of years. And finally, I just wanted to highlight a couple other numbers that are pretty interesting. First is that Fiverr's percentage of core marketplace revenue coming from repeat buyers remains steady at 65% over the last 12 months. So this is good. This generally means that people are coming back to reuse the platform, and that is always really great to see. It means that people are finding value on Fiverr, and they will keep coming back as long as they find that value. Fiverr's TROI, or its time to return on investment for its marketing, continues to be at approximately 3 months, which is all right to see. It means that if the company spends, X amount of dollars in about 3 months, they'll earn that money back due to the revenue that those ads brought in. So obviously we would love to see that number be like 1 day, right? But that's unrealistic. I think 3 months is a pretty solid number, and it shows that Fiverr still has a pretty long runway for growth ahead of it. And to back that up, we can see that their GAAP sales and marketing expense as a percentage of their revenue still remains at a very high amount at 43.8%, even though it was at 50.8% of their revenue last year. So the company is still heavily marketing, which is good. We do want to see that marketing continue because the platform could still continue to grow quite a bit. This graph at the bottom shows that trend really well. It basically goes from bottom left to top right, and the higher it goes with that green dot, the shorter their return on investment on their sales and marketing is. So we would like to see that graph continue to go up and to the right so that Fiverr is making more and more money more quickly from its marketing budget. So that's a brief overview of the company's current position in the market. Really quickly, before we move on to its financial numbers, can you please give this video a like and subscribe to my channel? It means a ton to me, and I would love to keep bringing these videos and this value to you. Thank you so much for taking time to view this video, and with that, let's move into their financial numbers. Fiverr's revenue has been on a tear, growing 47% per year for the last 5 years, although we have seen that revenue growth slow down quite a bit between 2021 and the trailing 12 months. EBITDA remains negative, so the company is not making an economic profit, but as I mentioned earlier, a ton of their revenue is going into ad spending for growth, and so all we need to do is see that growth continue and the ad spending slowly decrease as a percentage of revenue, and Fiverr should be able to meet its profitability in no time. The company's operating earnings per shares have grown really nicely since its IPO and recently just saw its biggest jump ever from 2022 to the trailing 12 months. Fiverr's gross margins have been amazing and very steady at approximately 80% since the company IPO'd. Their operating margin has improved significantly as well. It's still negative, of course, because the company does not have positive GAAP earnings, but it's really great to see this improvement over time. Return on assets, it's much the same. The company is not earning an operating profit, but we see really great improvement, and it's almost at the point where the company is making a positive return on its assets. With Fiverr's IPO in 2019, we saw a huge jump in shares outstanding. That is to be expected. And since then, every year, the company has issued more shares, but they have issued less and less shares every year. So that's pretty good to see. Their dilution is slowing down, and the company's valuation was really high for most of 2020 and 2021. So I'm not necessarily against them diluting shareholders when the company's valuation was just astronomical and they were getting a ton of money for each share that they were diluting. Cash and short-term investments have grown really nicely. It's been a little spotty in the last couple years, but in general, we can see that Fiverr is holding on to a decent amount of cash, which I think is the right move, especially given the turbulent times we are in right now. Long-term debt did see a big jump in 2020. I'm not against this at all because 2020 and 2021 were record low interest rates. We did see the debt again increase in 2022, and I'm a little less positive on whether or not that debt would have been taken out at very low interest rates or not. But in general, we can see that most of Fiverr's debt was taken out during a time when there were incredibly low interest rates, which I think is good for the company. And I think that was the best possible time management could have taken money out, so I have no issue. Their annual net interest expense is currently positive, meaning the cash that they have on hand is making more money in interest than their long-term debt payments. Levered free cash flow did go positive in 2020, which is really great to see, and that number is continuing to grow. So I have absolutely no complaints here. Free cash flow per share also looks great, and we would like to see this number continue to increase. And so moving on to the value chart, any of my longtime viewers might notice this change here immediately. So to go over this really quickly, this black line represents the weekly closing price of Fiverr. This solid purple line represents the fair value of Fiverr, and this thin purple line with these single dots represent the future projected value of Fiverr at a given growth rate. So just to give you an idea of how this all works, if I set my fair value PE to 100, we will see that the bold lines all jump up. And that is because we've set the fair value PE approximately 5 times higher than it originally was. And so we see that the fair value line increases at about 5 times. To change the growth rate, all I have to do is come to this projected CAGR box, and if I change that to something outrageous like 100, we can see that these thin purple lines now increase, showing the projected fair value of Fiverr in each year 2024, 2025, and 2026 if the company is able to grow at 100% per year. Now, coming up for a fair value graph for Fiverr has been really difficult. I have seen some sources say that Fiverr is projected to grow at 125% per year, which to me sounds pretty ridiculous. I've also seen some sources that say it'll grow as slow as 5% per year. And as you can see, the difference this growth rate makes and the range of these growth rates really adds a lot of uncertainty to Fiverr's future value. For me personally, I believe that Fiverr does have a decent runway for growth ahead, so I'm going to give it a projected CAGR of 15% per year. If Fiverr is able to grow at the rate it was expected to grow back in 2019, 2020, and 2021, 15% per year should be considered a very conservative growth rate for the company. And so with a fair value PE of 15 and a projected compound annual growth of 15% per year for the next 5 years, we can see that a fair value for Fiverr is approximately $28 per share, with its current closing price sitting around $22 per share. That represents a pretty decent margin of safety already, but if we consider that the company grows at approximately 15% per year, in 2024, we expect the company to be worth about $32, about $37 in 2025, and about $42 or $43 in 2026. This means that by 2026, under my current projections, the stock price could double. Now, one thing I would like to make abundantly clear is that this is just a projection. This will not and is not guaranteed. Do not buy Fiverr based on these projections. Please do your own research. There's also the kind of standard that when growth companies fall from grace, like Fiverr did, and it falls from $323 to $22 in the span of 2 years, it can take a very long period of time for investors to come back into a company. And we could see Fiverr stay undervalued for a very long period of time. The other issue with these assumptions is that Fiverr's growth could end up being 5% per year. It could end up being negative potentially. And so how you judge Fiverr as a stock today really depends on your growth expectations for the company's future. For me personally, I believe that 15% per year for the next 5 years is something that the company should be able to achieve outside of any major economic shock. And so that's the assumption that I'm currently going to go along with until I see any news or earnings that might imply that I have overvalued or been too optimistic with my projections. So for my final thoughts, what I really like about Fiverr is that it has great margins and it's an asset-light business. So there's not a lot of overhead costs. They really just have to take care of the platform, and the people will provide everything else. And they don't have to pay the people on the site. They just take a cut of all of the business that's done through the site. Second is that Fiverr is probably the top freelance job board in the world today. That could change over time, but as it sits currently, there is no other website that I can think of that would have more brand recognition than Fiverr for freelancers and for finding jobs for, a quick small task. And finally, I really like the company's progress on its profitability. We've seen that at annual numbers, it's not currently profitable, but the company has had positive free cash flow. Its operating margin growth has been exceptional, and I do believe that it will turn the corner of profitability very soon, and that really might just depend on when the company wants to stop winding down its ad spend. Now, what I do not like is that Fiverr will be highly exposed to economic downturns. This should make sense. It's a job posting website, and so if people cannot afford to employ others, then there will be less transactions and less work going on through Fiverr, and so that'll lead to less money earned by the company. Second is that there are variable experiences with freelancers. If I was to hire somebody to make a website for me, some of them might be excellent, and they might be completely worth the money, and they could create an incredible website, but there is the possibility that you have an experience where the person is just difficult to work with. They don't provide what you expected. They don't want to fix things that you come back with like, hey, I would like this changed. So there really is the potential for a very off-putting experience, and I would assume that it really only takes one off-putting experience on Fiverr to never come back to the platform again. So I don't think there's a lot the company can do about this. They do their best with reviews and with giving like badges to different people to kind of show like, hey, this is a top performer. So I think Fiverr is doing what they can, but there will always be this kind of question about, hey, I'm using this freelancer for the first time and I don't really know what to expect. And third, I believe that Fiverr's brand recognition is really its only true moat. There's not much outside of the platform itself that another company can't just build on. I'm sure if Amazon really wanted to create a freelance website, they could, and that would probably instantly kill most other companies, maybe including Fiverr, because Amazon is just a giant. And if Google did the same thing, or Facebook, or somebody did the same thing, I think it could potentially destroy Fiverr as a company. And the only thing that's keeping it going right now is that it is the biggest player with the most recognizable name. Now, do I expect Amazon or Google or Meta or anybody to waste their time with creating a job board like this? Probably not. But for these companies that are built solely on a platform, and that is what they are, they're really, really susceptible to disruption. And so that is just something that I like to make other people aware of, and something that I like to be aware of when I'm valuing these companies. So for my final thoughts, I think Fiverr's in a really interesting position. I'm not sure if I'm ready to buy yet, but that would mostly be due to me wanting to do more research, maybe just see how the current economic environment plays out a little bit. I do think the company has a pretty decent runway for growth, and the company has shown that it is fairly solid at executing on its plan. So if you were to invest in Fiverr today, I think it could be a potentially very lucrative investment. What are your thoughts? Have you used Fiverr? Did you enjoy your experience on the platform? Are you interested in becoming an investor in the company? Please let me know in the comments down below. And one more time, if you could, please like and subscribe. It would mean a ton to me. Thank you so much, and I hope you guys have a great day. Bye.